This is part 2 of a special podcast with guest Robert Hogue, where you will hear questions and answers. To hear the main presentation, listen to part 1. Welcome to the REITE Club's podcast, Real Estate Investing in Canada. I'm Laurel Simmons, and you're listening to a special interview with Robert Hogue. Robert is a member of the Macroeconomic and Regional Analysis Group with RBC Economics. He is responsible for providing analysis and forecasts for the Canadian housing market and for provincial economies. His publications include Housing Trends and Affordability, Provincial Outlook, and Provincial Budget Commentaries. In his functions, he's frequently called to comment on the economy, both internally within RBC and externally with clients and the media. I could have talked with Robert for hours. He shares so much incredible information. I hope you enjoy listening to this interview as much as I did participating in it. So to see the charts Robert presented, go on over to our website, thereiteclub.com. Sign in, it's free, and you can watch Robert's interview. And while you're there, poke around. We've updated the website and we have wonderful things for you to discover. So now let's go to the interview.
We could talk all afternoon. I mean, this is such a big topic, right? It truly is. And I have some questions, specific questions that people actually wrote in and asked. So I'm going to start with those, and then we can have a conversation about that. So let's talk about, and this was from Corrine T. Actually, she asked, so do you think, and again, I know that there's nobody has a perfect crystal ball, right? Would that we did.
Not even economists.
Yeah. So over time, do you think that house prices will be sustained, particularly as you talked about immigration? Because a lot of people, especially investors, but everyone actually, they're worried about the crash, we call the crash of housing prices, real estate. But I mean, if you're living in a home and you're there for 20 or 25 or 30 years, you really don't care, right? It all sort of evens out in the wash. But if you're an investor, you might care because that's an asset that you want on the books, and you don't want to see it turn into a vast liability because your mortgage payments far outstrip the actual value of the house. Mm-hmm. So
if the question is, are we concerned?
Yes.
Yes, we are. I think what I describe is a very, very strong fundamentals now. Low interest rate for a long period of time. Immigration eventually will come back, will provide this kind of demographic based kind of demand for housing. But those strong fundamentals in my book don't justify 20+% price increases. In some of the smaller markets, we're talking more than 30% year over year. This is right now conditions that are altering price expectations. My economists call it extrapolative expectations. So we just saw what happened over the last 12 months, and many people expect that this will continue to happen going forward. And this is creating this kind of sense of urgency, this fear of missing out, that a lot of buyers, I suspect, are rushing into, buying something before it's too late, before, they can't afford. And just did a report last week, and looking back in last 6 months, and overall in Canada, prices have increased more than, like your benchmark price has increased more than 100,000. So there's a lot of buyers out there that if we wait another 6 months, this is going to be way out of our price range. We won't be able to buy because prices never fall. We'll never be able to buy again, to become owners. So our dream of home ownership is going to be crushed. So, and a lot of that contributes to even faster rising prices. So I think it's the kind of market psychology right now is just not healthy. This is not good. If you want to call it a bubble, by all means, I think it if it looks like one, smells like one, it probably is one. But So obviously there are many kind of related questions to that. I don't know if you want to ask them or should I ask them myself, but really I think it begs a question about some kind of policy intervention to cool things down. We've seen bubble episodes in 2016 in BC and Vancouver. Provincial government eventually intervened, put a housing plan. Essentially, they put this, amongst other things, slapped on a foreign buyer tax. 2017, the spring 2017, it was Ontario's turn. Kind of similar broad conditions, prices rising. Most of southern Ontario, more than 30%. Provincial government suite of 30 measures, including a foreign buyer tax. So there's a pattern there. I think policymakers have demonstrated now a limited tolerance for bubbles this time because it's so widespread. It might not be, the intervention might not be at the provincial level or local level. It might be more at the national level. What can be done is still a work in progress as far as I'm concerned. But I think the odds of some kind of policy intervention has risen tremendously. One. Second is if nothing gets done, and if those prices continue to spiral upwards, at some point, something's going to give. And then, we're not talking, our base case right now is more kind of a soft landing. Eventually, probably prices, in our view, are not just sustainable, but they might not just come crashing down all at once. That was true at least when we did our forecast back in January. Now we might be considering a harder landing, a lot more in terms of a base case scenario, but that's still kind of what could be the trigger. It's probably higher interest rates, and that's probably more of that 2022 story, maybe second half. So all this to say that there are some, the current market conditions are problematic.
I mean, one of the people asked, and I too, so we've all seen this in the news lately, that how New Zealand implemented, 40% down payment, requirement for investment properties. That's a pretty radical policy to make it, yet they did it. And do you see something like that happening here?
I would not exclude it. I'm not sure if I would necessarily be the one advocating for them, but there are other aspects of the New Zealand package that I find kind of interesting. The thing to keep in mind is that in New Zealand, at least the evidence is pretty overwhelming that investors play a large role in their own version of this housing overheating or bubble, however you want to call it. Whereas here, I'm sure there's investors do play a role to a certain extent. I'm not entirely sure if that's the main force. If you were to tackle investors, if that would necessarily address the issue, but it could be certainly something that policymakers will be considering. From a politics, if you think, if you were to put in your politician's hat here, it's probably a course of action that's probably less risky, politically speaking, than targeting first-time home buyer, or tightening mortgage lending rules for first-time home buyers and that kind of stuff. Especially in the federal context, with an election being rumored, and in a few months from now, I think that's less likely. However, using a hammer to hit the investors, I think it might be a kind of the path of least resistance.
So I want to go back to one of the things you mentioned about, the sort of the outlying areas, because when one of those graphs or some of those graphs you showed, so the smaller towns and cities where they have massive annual growth. Like I'm in the Niagara region, and
Yep.
Niagara on the lake, and I'm looking at prices, and
You've seen it.
I'm just going, are you out of your mind?
Yep.
I wouldn't buy.
Yeah.
In fact, I'd say to someone, you have to pay me to buy that house. But I know people who are buying it for, oh God, tens, if not hundreds of thousands of dollars over asking, and which is inflating prices. But at the same time, we're seeing this huge outflux of people from the more dense population centers like Toronto, like Montreal, like Vancouver, spreading out into the areas. So that too is driving prices up, right? Because there's only so much supply.
That's true, and ultimately, I mean, this is something. I mean, that's if we go back to the pre-COVID policy discussion, or the main topic was, well, we need to focus really on the supply side. We need more supply out there. It's clear, especially in the context of the Canadian context, where no, immigration is really strong, and we were having just before COVID, Canada's population was growing 1.4%. That's something we had not seen in like 30 years. Very strong population growth. So fundamentally, your housing stock needs to expand, and this is where the issue has been. Demand has been growing for demographic reasons because interest rates were low, probably not as low as they are today. And but on the supply side is not able to adjust quickly enough. So for those of you who've taken Economics 101 courses, when you got strong demand, supply is relatively fixed. The adjustment mechanism here is price. So for the longer term solution, which still remains the case here, is to focus on the supply side, address issues that are in the way of builders to respond quickly. The length of approval process, for example, and the cost of development charges and everything that really all contribute to affordability issues. And so that's fundamentally, but right now, supply side measures would take too long to address the issue. Now, I think it makes sense from a policy perspective, to use demand side type of tools here.
And at the same time, you mentioned the immigration policy and the fact that we're not right now, but as soon as the gates are opened and we have all these people coming in, that's going to put more pressure on housing, right? There's not enough supply right now. We know from StatsCan reports, and I mean, God, 5-6 years ago, that Toronto was getting 10,000 new people a month. It was. I mean. Yeah. That was insane. Like, that was more than the state of California or New York City, because Canada is a really an attractive destination for permanent residents and immigrants. So do you have any indication as to how we can handle that? I mean, I guess it has to be a lot.
Well, I mean, but that being said, I don't want here to imply that there's been no supply response. I mean, there's very strong construction right now. It's just that it hasn't reached the end of the pipeline quickly enough to meet demand that's right there in the field, right? And to its credit, in Ontario, for example, the provincial government has focused on the supply side. And looking at various ways to make the production of new housing quicker, and not quite sure if they've been that successful in making less expensive, but certainly to expedite the system. So there is a supplier response, and but there's still need for more.
So I want to ask you a question about jobs, just because I mean, jobs is such a fundamental sector. It's everywhere, and jobs drive our economy. The more people who have jobs, the more money there is in the economy. The more people spend and can buy things and houses and all the rest of it. And you touched on that in your presentation about the fact that savings are going up, but that in the lower the service industry and the lower paid people, right? The jobs have really fallen off. So as we recover from this pandemic, more jobs presumably will be created in those sectors.
Yeah.
We're starting to see that now, I think.
Yeah, and that's probably the missing chunk here. When I was showing the employment has picked up, there's like a 20%. We're still down 20% relative to, in terms of employment, relative to pre, and that's largely, I think, of that 80%, about 80%, the 20% missing, there's about 80% that are in the hospitality, restaurant, airline travel, and all that, tourism, for example. So, and those can only come back once, we reopen and people feel comfortable enough to be out there and travel around the country.
Right. So, well, here's hoping, right, that the vaccines really get out there, and nobody knows for sure what's going to happen, and we can, we'll just we can only do what we can do. But I was really interested to see too your stats about the savings, because we'd all heard that Canadians were saving more. I hadn't realized it was that much. That's like, can you imagine 5 years ago how happy the feds would have been, and everyone would have been if they'd seen all those savings in bank accounts? It's going to go somewhere, right?
Yeah, and that saving, well, we all know where that savings went. Housing and the stock market. Yeah,
and I think too that, I keep hearing about the Roaring 20s. I don't know about you, and I think you kind of alluded to that, but I keep hearing this over and over and over again about the Roaring 20s, that we really could be heading into that kind of, you want to call it economy or lifestyle or whatever it is. How much of an effect do you think that will have on the economy or in general, in terms of inflation, like whatever's going on? Because we haven't talked about inflation.
Yeah, I mean, we're all hoping we'll get some kind of roaring.
Roaring something.
But hopefully not over exuberance. And this is where the risk might be, right? We're seeing right now in the housing market some form of over exuberance, like people are just, going too far. But more broadly, this over exuberance could lead eventually to sustained higher inflation for a period of time. And this would be damaging in the sense that this is what central banks are afraid of. Temporary blips in inflation is not a big deal. The Bank of Canada has been quite clear that it does expect inflation to pick up over the coming months. It's largely what we call a base effect. Is just when you compare to, when you do a year-over-year percentage change, you got to look at the year before. The year before, the cost of a basket for consumers had dropped quite a bit. Largely, it's a gasoline price story here. So, in the coming months, we're going to see a little bit of let's call it a flare-up in inflation. It's going to pick up a bit. But what the Bank of Canada and other central banks really care about is inflation expectation. Does that mean if inflation goes up to 3%, does that mean that on a go-forward basis, everybody will be expecting 3% inflation? And right now, the answer is no, probably not. Inflation expectations have been incredibly well anchored around 2% for decades now. And the Bank of Canada doesn't see any change. Now, would a Roaring 20s kind of change that? This could potentially be a risk if people become overly exuberant and are willing to pay whatever price because they feel whatever happy.
Yeah. But so you're saying it's not a big risk right now. I remember the days of high inflation, and there's a certain demographic of us who do remember those days.
Yeah, but you also remember what it took to get inflation down to 2%, and which is what is the painful part, right? And this is what we have to keep in mind with respect to monetary policy, because what it took was effectively, the Bank of Canada would probably not entirely agree with that, but really the early 90s recession in Canada was largely driven because the Bank of Canada was adamant to rein in inflation expectations. So it ran interest rates higher longer than it needed to get the economy back on track, because it wanted to rein in inflation expectations around what the target. And the experience has been so painful that ever since, that 2% has been tattooed on everyone's brains. that this is the normal rate of inflation. This is what the Bank of Canada is setting its policy, or that it is its target, and it will do whatever it takes to keep it that way on a kind of on a trend basis, right?
Wow.
So
in other words, we have to keep keep an eye out and an ear open for what the Bank of Canada, their rates are and how they're managing it. Because if they're trying to keep it that steady 2%, then I suppose if it goes down. So here's a question: we got inflation roughly at say 2.5%, whatever. If it goes down, and it could, I guess. What does that mean?
It is down.
Well, oh yeah, okay. So what does that mean?
Last 12 months has been down and then even
Okay.
fell below 1%.
Oh, okay. So I guess that means people aren't spending. They're not buying. They're not spending, except for the things that they, like, especially in the real estate investing area. Like when you're trying to buy products, for example, you want to renovate a house. Well, the price of a 2x4 has skyrocketed, right? Like it's just skyrocketed. Again, supply and demand. The mills were shut down. A lot of people are doing renovations in their houses because they're not traveling, so they're spending money on that. But we do see sort of uneven, I guess, price increases. But I guess when you average it all out, it
Correct.
really doesn't make much difference.
And that's something to keep in mind. I mean, there's no denying that there are some price pressures in certain parts of the economy. This is clear. You mentioned lumber, but I can give you a whole list of metals and as well. I mean, there's costs are rising in certain parts of the economy, that's for sure. But at the same time, if think of airline tickets and other parts especially on the services side, which is the biggest chunk of the economy, by the way. And when you look at your basket of goods and services that you consume every month, services are a big chunk of it, and those are not under the same kind of pressure at this point. And so the Bank of Canada, when it sets its policy, actually looks at the larger equation here, not just home prices are rising or the lumber is increasing or copper is doubled in price or whatever it is. It looks at the broader picture.
Right. And as they have to. So, well, I am going to leave it at that. I really thank you. This was a great conversation. I could just sit here and talk to you all afternoon, but we all have other things to do. But we really do thank you, Robert. It was really, really wonderful. And again, we will display the links where people can get the reports and get onto the RBC and grab all kinds of great things. So thank you so very, very much. And we hope to see you again.
Okay, well, it's been my pleasure. That was fun. Thank you.
Okay, bye-bye.
Bye.
I hope you've enjoyed this special podcast with guest Robert Hogue. We really appreciate it if you'd rate our podcast, because it does help us to reach other people who are interested in real estate investing. Thank you for listening. And as always, I want to remind you to come grow with us. Bye for now.